Hello, everybody. Welcome to Market Talks. I'm Ray, head of markets at Cointelegraph. Here we discuss the latest in what's shaping the markets with valuable insights from industry leaders, traders, and influencers. Today's show is sponsored by XGO. Our guest today is Brent Xu, founder and chief executive officer of Umee, a decentralized finance hub built on the Cosmos SDK that offers tools for macro level borrowing and lending applications. Before founding Umee, Brent led strategy at Tendermint while also setting the strategic roadmap and partnerships for the Cosmos ecosystem. Here's a short video intro about Brent. Hello, Brent. Thanks for coming on to the show today.
Hi, Ray. Really great to be here. Thanks for having me.
How are you doing?
Doing good. Just watching the markets evolve and building cool protocols to help contribute to the development of blockchain ecosystem. Uh, same old these days.
Same old, same old. Yeah, I'm with you on that. So it's hard for me to talk to people about work that I've known for a long time, including my wife, because we do the same thing every day. Like crypto has its ups, crypto has its downs. There's new projects that come out that we explore. Um, the Securities and Exchange Commission is always suing somebody or threatening to shut down some platform or sending out a Wells notice. Bitcoin price goes down 2 or 3% because of that, and then the next day it goes up like 5 or 6 or 7%. So while it's a place that has a lot of volatility and there's always like a lot of emotional whipsaws and even price whipsaws, it all kind of it's the same, we know this ocean, right?
Certainly, when you've been in the space long enough, it all just kind of melds together, and you get used to the volatility, you get used to the development, you get used to the regulations, and you just keep building. There's nothing else to
Just
it.
keep moving. That's right. That's right. I guess it kind of intensifies your focus. The thing I like about bear markets is at least there's no need to FOMO. There's no pressure to feel like you should be chasing after these assets. You don't have to worry about selling or taking profits on anything because if you're a terrible trader like me, you're not profitable. So you can just kind of focus on planning, thinking, researching, and preparing for the next steps that when the market changes and things become bullish again.
Oh, certainly. And as a software development shop, you focus on hardening your protocol, making sure you have the right technological foundations, and sometimes these bear markets are sort of relief for the builders out there. For of course, we want the bull markets. We want to see lots of activity, and we're always anticipating the next flow of this cycle.
Right, right. I'm sure everyone in the audience wants to know when is the next bull market coming, but that's not the topic of the day. Let's talk about what's happening in the financial world, both in crypto and outside of crypto. There's a lot going on. And this month, we saw some startling cracks in the US banking system. There were some eye-browsing kind of liquidity backstops, which some would categorize as bailouts. And then this week, we even saw a handful of nations decide to start settling trade in their own currency instead of using the US dollar. Now, what's interesting to me is despite this, Bitcoin has made some really strong attempts at the $29,000 level. It's up 72% for the year. It's up 40% for the month of March. All of this is happening in the face of some of the strongest enforcement from regulators that we've ever seen in the US. And in the forefront, there's also continued worries about US inflation and the health of the economy. So, in your view, what's going on? And within what context should investors digest all of these events?
So I think investors or market participants should be looking at all of this from a very holistic perspective. So a lot of bad things happened recently. Interest rates are increasing at one of the highest rates in history after seeing a large amount of quantitative easing since 2008, since the mortgage crisis. So we have that going on. We also have banks being unable to react to these significant interest rate increases due to a lot of the fixed income securities that they hold based on a held to maturity accounting standard. And so this is damaging the banks. They're being acquired, they're going bankrupt, they're being seized by the federal government. That being said, this type of cycle happens every, let's say, 10 or 15 years. It's sort of a revolving cycle. We saw it with 2008. 2008, we saw a giant collapse in the financial system. We saw close to $50 trillion of value just disappear from the global economy. Mortgage-backed securities were deemed toxic assets, where a bond that's normally valued at 100 cents on the dollar was suddenly valued at 15 cents on the dollar. And so there's a huge degradation of value. I think the way that any investor should be thinking right now is that not if everything's going to end or everything's going to be destroyed. It should be, what are the phoenixes that rise from the ashes of a lot of this bad economic infrastructure? After 2008, after a lot of the banks collapsed during that time period, we saw a lot of neobanks emerge. We saw a lot of new lending platforms like the lending clubs and the SoFis of the world become very dominant. And I think from an investor's perspective, they should be looking out for the next set of major unicorns and the next set of major forms of innovation that are going to help fix the problems that we've seen in this recent collapse.
I agree. So you mentioned that QE started in 2008. That's when I think Obama bailed out the automotive industry and some brokerages also, and save the economy. And here comes the helicopter money, right? And we saw kind of like a similar response in the way that the government responded to COVID, which was basically providing stimulus for the entire economy. That leads to inflation. So, of course, it makes sense to eventually curtail that spending and raise rates. But as you mentioned, 9 rate hikes in 1 year has caused problems for the corporate sector, for banks, and I'm even hearing rumblings about the impact of these rate hikes on future government debt. What's your view on that? I hear a lot of talk about yield curve inversions and bond repricings and all that. Like, how is that relevant to crypto? How is that relevant to the wider economy also?
So, from the perspective of a bond trader, or from the perspective that anyone who's looking at global debt markets and the current scenario of how things are put together, the mantra that one must understand is that interest rates always tell a story. And the story that they've been telling since, I'd say, early 2021 is that there is a likely recession coming. This is due to an inverse yield curve. This basically means that long-term rates are actually lower than short-term rates, which in essence doesn't make that much sense, because if you're lending money for a longer time period, technically you should be rewarded for more risk. And so the professor who came up with this concept is Cam Harvey. He did research on interest rates and inverse yield curves and discovered that these are very strong models for determining economic recessions. And the way to look at this yield curve inversion is to look at the difference between the 10-year rate and the 2-year rate, or the 10-year rate and the 3-month rate. And we've been seeing one of the most negative spreads since like the 1980s, where there was massive inflation that was also happening in the broader ecosystem. So, what does this mean for the banking sector? What does this mean for the bond markets? Um, so, as the Federal Reserve has been dramatically increasing interest rates subsequent to many years of easing. So, the easing happened after the mortgage collapse. Basically, there was a program called Operation Twist. There was a TARP that was used to provide more funding into the broader global economy. And these things resulted in quite a bit of easing to just help stabilize the economy after, like I said, 2008, 2009, $50 trillion of value disappeared from the world. Um, because that mindset increased subsequent to COVID, it resulted in a global economy that was just thriving and bullish. And the Trump presidency also contributed to this in that he was doing everything he could to stabilize or just increase the throughput of the economy. But these massive rate hikes that happened, you mentioned 9 times in the last year in 2022, it just showcases a sudden knee jerk. And whenever you see a knee jerk reaction like this, the economy can't really withstand that big of a shock. It's almost as if suddenly you put on the brakes really hard while driving a car. And so what we're seeing is some of the reactions of this. Similar to 2008, 2009, there were many banks that collapsed. Bear Stearns and Lehman Brothers, they collapsed, they got acquired. Bank of America acquired Merrill Lynch. Um, Washington Mutual got acquired by JP Morgan. Just different acquisitions that happened in the banking sector. And we're seeing a little bit of that today with different acquisitions like Credit Suisse, Signature Bank, Silvergate. And in summation, what this means is that the economy can't handle these types of shocks. And it's really a result of just different political regimes that manage how the global economy should be designed to grow.
But this places the Fed between a rock and a hard place, doesn't it? Because inflation is still sticky and problematic. Therefore, further rate hikes should occur. We're not yet at the Fed's terminal rate. Also, we're not near where target inflation should be. Yet now we see that the result of rate hikes, or at least additional rate hikes from where we are now, makes things very difficult for banks. So, how are regulators or how is the central bank meant to navigate this issue? On one hand, you have a collapsing bank system because rates are too high. On the other hand, you have inflation being sticky and just waiting to resurge if there's a pause in this rate hike policy. So, it's not fair for me to ask you what's Jerome Powell supposed to do, but I'm asking you.
It's literally the hardest question because you're absolutely right. They're stuck between a rock and a hard place. Do they damage the economy more? Do they help save the banks that can't fulfill deposits? I'll make this distinction though. So this crisis is a little bit better than 2008. 2008 was more of a black swan event, a situation where no one saw it coming. People thought things were okay, that the housing market was going to be fine, and all of a sudden, massive defaults and toxic debt products that destroyed value. This current scenario wouldn't necessarily be a black swan. It's a little bit more like a gray rhino. And the way that you can describe a gray rhino is that you see it coming. It's big, it's a huge rhinoceros, and you know that it's coming towards you. And the way that you should look at the economy is that when the Fed increases interest rates this aggressively, yeah, like no doubt there's going to be bad circumstances. The Fed obviously had a difficult choice to make, whether they continue with the uh, BTFP program or they continue the rate hikes to combat inflation. And due to the fact that they had this difficult decision of being able to manage both the hyperinflation environment as well as keeping banks safe, I think they kind of made the right decision. It's 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 hard to say. I think Twitter's going to go nuts when they think that they're going to talk about stimulus and just injecting money into the economy. But all things considered, I think this was sort of the right balanced path to take. They had to do it this way. They had to figure out a way to tame inflation and keep deposits safe because deposits are the foundation of our banking system. If you can't trust your money in a bank, then what can you trust anymore?
That's true. I just get the impression, and I think a lot of investors and just the market in general gets the impression that the Federal Reserve is doing this on the fly. They are creating policy on the fly. They're triaging, which when you have no choice but to do that, let's say in a battlefield environment, you got to do that. I understand that, but having a plan and being more strategic is what we and the public expect from our leaders. So I understand that they're doing the best they can, and I'm definitely not any more intelligent to suggest what they should be doing. But as someone looking from the as a observer from the rafters, it doesn't seem to be working. So I want to zoom out and look globally, and see if there's a connection between U.S. banking issues, high inflation, this yield curve inversion, and this week Saudi Arabia, Kenya, Pakistan, Russia, India, and Brazil deciding to settle trade in their own currencies, and in some instances, the yuan. Why have they decided to do this? And do you think it has a significant impact on the US economy or the US dollar or the DXY index?
I think there are definitely political implications around all this. Um, I'm not a political expert, but I will make a major comment about something that I've noticed about this news, because one really important distinction to make is that these countries want to have faster settlement, better technological components to their overall settlement capabilities, and the US dollar is not really giving them that ability. The US dollar is just very stagnant in terms of technological development. There's sort of a play on CBDCs, but not really, and they're not really making that step to create a better settlement layer, a better interface for the next 20 or 30 years of technological growth. So I think one perspective is that these countries see that, well, US is not innovating on tech. Maybe we need to figure out ways of building our own technology around faster settlement and more effective CBDC infrastructure. And I'd say that these countries have a mindset to take that approach. And in that way, I think the US is being left behind in certain ways. One thing I will note is that crypto kind of loves the US dollar, in that like 95% of stablecoins are USD denominated. And so I think the US dollar still has a pretty dominant presence in global economies, well, particularly in crypto. And the reason why crypto still reverberates around the US dollar is because it's so much easier to settle Tether and USDC and DAI over the blockchain than anything else in the broader financial system. And so these are just different pieces of the puzzle that I think help inform this rebalancing of global currency between different nations and how they work between each other.
That's a perfect segue, because in the US, we've seen key crypto-friendly banks temporarily removed from the scene, right? They've been shuttered. The bridge from fiat to crypto and back and forth, or on-ramping in and out of crypto, it's under attack, right? It's under siege. So what do you foresee happening in the short term?
Short term, I think this banking ecosystem is going to recalibrate and switch around. So this happens in banking all the time because banking is such a fungible business. If Deutsche Bank doesn't work, let's use Credit Suisse. If Credit Suisse doesn't work, let's use Bank of America. If Bank of America doesn't work, let's go to JP Morgan. At least from um, a base layer user perspective, banking is quite interchangeable. And so we've been in crypto for quite some time. Crypto friendly banks always emerge because they want to either explore a new business model, take some market share from their competitors. I also think neobanks are pretty great. I think neobanks, as they develop new ways of building out their business, they can start onboarding crypto. Um, that being said, banks recover. As a lot of people saw, Silicon Valley Bank debt went down in value. But it doesn't mean that distressed debt investors weren't buying back this debt and basically betting on a successful recovery, and that the debt going from 50 cents on the dollar back to 100 cents on the dollar. And so the truth of the matter is banking's pretty fungible, and there will be solutions. There will be new players that come out. Initially, there might be more offshore approaches to accessing the banking network, but this is a cycle, and we've seen this happen before. And as crypto OGs, we're kind of numb to the fact that this is just business as usual when it comes to big regulators trying to put pressure on the development of this new technology. This happened in the ICO bubble. Like ICO bubble, regulators are going after a lot of projects and just putting pressure on them. Like China banned crypto at least 5 times, right? Right. So this type of pressure is just uh, it became normalized in the development of this space. And similar to sort of that Jurassic Park reference, life finds a way. I'd say that technology also finds a way.
Good analogy. What's your vision for how DeFi protocols and crypto exchanges can build out their own banking services in the future?
So I my real thought process around this is that I think with three big factors, if you have enough scalability, interoperability, and privacy in a blockchain network, if you have these three components, a blockchain network can replace an entire banking and financial system. And that's why I came into this industry. When I was working in bond trading, so I spent over half a decade trading bonds on a bond desk. When I first went into the industry, I thought maybe this industry is full of math, it's full of finance, full of logic. But after working in that industry for so many years, I realized that, man, there wasn't that much. I mean, there's math and logic, but this industry was dominated more by human relationships and idiosyncratic methodologies based on legacy systems that were built over like 100 years of financial development, which was bad because there was a lot of inefficiencies. It was broken. The reason I went into crypto is because this is open source technology and DeFi exists as open platforms. And if you're able to provide new levels of transparency into how the capital markets work, you actually make them more efficient because then people can't cheat. People can't um, negatively modify the capital markets based on having black box information or just opaque systems. And so I really do think that with those three factors, interoperability, privacy, and scalability, a blockchain network can replace all banks, all financial institutions, and all capital markets. And that's the basis for what what we try to build towards.
So to me, it sounds like you believe just integration of the technology, blockchain becoming more immersed within this traditional system is the solution. Because on the flip side, you have people that are purely like they're more like tradfi agnostic and want to get away from it and are looking for completely new solutions in DeFi, such as Terra Luna and Abracadabra Money and Maker, Compound, all these places where you can self bank and give your crypto utility. And DeFi protocols had their attempt at building out their own lending and borrowing services. The code works, but bad actors involved in those platforms, or like a lack of good structure in terms of like risk management and having the right people on staff to set up those processes, I think led to the kind of temporary downfall of most of those DeFi protocols. So, in your vision of DeFi and banking services, is it just Fidelity and JP Morgan, Goldman Sachs, Wells Fargo, Bank of America basically shifting a lot of their workflow onto Ethereum or onto Cosmos SDK? And I just don't see it. It's invisible to me when I go log into my bank account or I'm using my mobile app. It's all blockchain powered, but the UX still looks like what I knew before, and things are just faster, more transparent, and maybe there's fewer fees. or do you foresee DeFi still being its own kind of universe that has its own banking system and is somewhat completely separate from traditional finance?
I've thought about this quite a bit in the past, and I don't really think JP Morgan, Fidelity, Goldman Sachs, Morgan Stanley, I don't think that they're necessarily going to make the right innovations. The comparison I like to make is it's a little bit like the Detroit auto industry trying to build electric cars. GM, Chrysler, these companies are not going to be able to innovate and develop on electric cars as fast, as effectively, because they have 100 years of auto development based on past infrastructure that's kind of holding them back. I think the real innovation that's going to happen is new companies, new platforms that built based on new fundamental infrastructure that doesn't rely on this Web 2 infrastructure, that doesn't rely on TradFi systems, but instead rebuilds from scratch. And I think these are the things that are going to be dominant for the next set of decades where banking is going to be reinvented. Uh, One of my lawyer friends gave a pretty good analogy. He described this blockchainization of the world as sort of a marketization. So similar to Uber, basically marketizing the ride sharing service. For example, taxis are very structured um, transportation services, but Uber, because they vary the charge based on uh, the time and place that you obtain a ride, you create a marketization mechanism of it. Crypto is like pure marketization. You're basically making a market of everything. Now, I think that force is the thing that is going to help drive the development of how a lot of these technology can become useful eventually. And that's the basis of what we're doing when we're building a lot of this tech.
Hmm. So, in that regard, and also in connection to DeFi and just making markets, what does Umee do?
Certainly. So UMI is a cross-chain barn lending protocol that connects between Cosmos and Ethereum. We're a base layer blockchain. We're layer one, built using the Cosmos SDK. And our overall vision and mission is to bring the bond markets or the debt capital markets to crypto, basically to build a better financial infrastructure for expanding the borrowing and lending ecosystem. And so, one way that we look at it is that the debt market can be based on a pyramid of transactions, and that the base layer of the pyramid is just pure money. So, pure monetary instruments like fiat, stable coins, and other monetary instruments like euro dollar. The second layer would be around something like short term lending or the repo rates. Third layer would be something along the lines of a capital markets framework. And then the top of the pyramid would be the credit markets. So Umi focuses on building the base layer, the plumbing, the infrastructure of the debt markets. And we envision building out a set of foundations to eventually onboard the broader debt markets into a crypto space where there can be more forms of enterprise value that's generated in this space. Um, so we got a lot of things cooking and rebuilding debt primitives, and we have a lot of new ideas that we want to contribute to the open source DeFi space by building out these solutions.
So, what role does regulation play in DeFi development as you foresee it? And even with what you're attempting to do at Umee, like everything that you've described sounds like okay, there's securities issuances, there's all different types of stuff going on that definitely regulators would want to say on or to sign off on. So, how are you guys navigating those waters right now?
Oh, Ray, this is everyone's favorite question. Everyone just loves this one, right? It's um, so regulation is important, uh, and the key to regulation is understanding the Overton window of how different forms of regulation are instantiated. Uh, Different practices that existed in 2018 were undefined, and better clarity is created in 2020 maybe better clarity is created in 2023. The regulatory landscape is constantly evolving, and we see this happening as different political forces cause new types of regulation, especially when it comes to the politics side of things. Different political regimes have different thoughts. That being said, when it comes to DeFi and the broader crypto regulation ecosystem, it's important to basically create a way where this technology can be used safely as well as effectively. Um, the biggest challenge, I think, and I think the most lucrative market there is going to be in the future is protocols that figure out the right interface between TradFi securities and DeFi assets. Because if a protocol can make a right interface between a KYC product, like let's say, um, I'll just take a random example. Let's say there's a KYC stock platform that has actual equities that coincides with a DeFi platform that has tokens, and there could be a good interface between how KYC users on the equity side of things can also participate in the DeFi market. That's going to be a very innovative use case, and that's going to be a very powerful product. The key to making this work, though, is to make sure that DeFi still stays open source, stays open ecosystem, and still stays open platform. And I think the challenge that folks have been having, so listen, tokenized securities have been trying to be built for the last like 6 or 7 years. There's tons of companies that are trying to do it. No one's done it right yet because there's just such a disconnect between the DeFi space and the TradFi space. But the company that actually puts those two together and creates a user interface where you can still be KYC'd on the security stuff and still be free on the DeFi stuff, that platform is going to make a lot of money. And that platform, once they figure out the right regulatory framework to use, is probably going to be a very powerful protocol.
Yeah, yeah, I agree. Maybe when Gensler's term is over, or perhaps when he's replaced, and we get someone who's more interested in like developing a framework between the legislature, the executive branch, and like in industry, then maybe we can see that growth because it seems like I've heard about a lot of different crypto entities trying to play ball fairly, even Coinbase, and it's just not playing out in their favor from the regulatory side.
We just need more clarity. We just need better framework so we know what we can build. All this ambiguity is just not really helping.
Yeah, it's not helpful at all. So to go back to crypto a little bit, there's a lot going on in the economy, yet Bitcoin is pulling away and crypto valuations continue to rise. Why is the market not crumbling as other markets crumble? Usually the correlation between, equities and big tech and the DXY and Bitcoin, they're usually kind of correlated together, not in an inverse way. So why do we see Bitcoin showing such strength now? When there's bearish headwinds. What's your take on that?
Yeah, it feels like there's a little bit extra beta in the Bitcoin side of things compared to the broader markets. And you probably have followed the Balaji bet, basically betting on a $1 million
Mhm.
Bitcoin. So I think his bet is more of a simulation of a long-term multi-year trend that he sees, and he's trying to bottle it up into a 90-day period because he just loves Bitcoin so much, which is great. I think long a viable bet. Short term, obviously, not enough liquidity or volume to justify that type of thing. The results of this recent appreciation of Bitcoin and crypto is likely due to the foundation of that bet. Basically, if there's going to be a banking collapse, if there's going to be a negative economic event, Bitcoin can be a solid monetary unit to be used for value accrual. It's funny. Back when I was first working at Consensus, we were paid in Bitcoin because Consensus couldn't get a bank account to successfully pay employees fiat. And learning about the monetary aspects of Bitcoin was one of the most enlightening aspects. So a short adage. The reason I got into Bitcoin was a professor named Campbell Harvey. So he was a professor who's known for inventing the concept that inverse yield curves result in economic recessions, and he had done his dissertation for his PhD on just inverse yield curves and basically their effect on the global economy. And he had actually became disillusioned about the global economy after 2008, 2009. He actually stopped teaching because he was like, man, the economy's really messed up. It's a really broken system. And he didn't really start teaching until the invention of Bitcoin, where he actually developed a new hope for how economic systems can be built based on open source technology. And so Cam Harvey was kind of the guy who got me into crypto, and basically his view on both the economy in terms of how global economic systems are built, along with the foundational aspect of an open source protocol like Bitcoin, really solidifies a lot of like that past knowledge base, and just the development of crypto technologies really influences what people think about today in terms of value accrual related to digital assets. So I think, uh, in summary, I think the foundations that were set many years ago by early Bitcoin folks and early crypto folks set the precedence for why folks today realize that there is additional value affiliated with crypto compared to the broader economy in which these values are decoupling. That being said, I love Bitcoin, but I also see a bit more opportunities in some of these proof of stake chains, because I think from a proof of stake perspective, most of the innovation, most of the new developments are happening there, and I see um, higher beta in terms of uh, technological value accrual compared to Bitcoin, which is more of a foundational store value that set the foundation for how all this stuff is being built.
So, what's your multi-year vision for Bitcoin and Ethereum adoption? And I ask only about those two because we see Fidelity continuing to build out crypto custody and crypto services on their platform. And then I hear that Nasdaq is also building a crypto custody platform, and all the big boys are still building infrastructure that is crypto specific, but usually oriented on Bitcoin and Ethereum. So, what's your multi year vision for Bitcoin adoption?
Multi-year, I'm long-term bullish on Bitcoin. Obviously, when a lot of the banking collapse was happening, people were actually selling their USDC for Bitcoin, and they were selling it for Ethereum as well. I think Bitcoin has that foundational component to crypto. Bitcoin will always be here. Bitcoin will never die. Bitcoin will be Bitcoin is just too powerful at this point. It is the foundational component to how the broader blockchain ecosystem has been built. And on Ethereum, I think Ethereum is actually, you can think of it as a call option on the success story of blockchain being able to replace and reimagine fintech. So think of Ethereum as a call option on just technological development. The developers in the Ethereum ecosystem are constantly building, constantly innovating, going to ETH 2.0, going through the merge, purge, verge. All of this roadmap is just direct indication of multi-year mindset when it comes to future innovative products. And just folks like myself, we try to take a page out of the Vitalik playbook, or take a page out of the overall development playbook to figure out how to build more and build better. And so you have these two unstoppable forces. One, Bitcoin just being completely unstoppable, and two, Ethereum ecosystem being a beacon of technological development. The fact that Ethereum is able to succeed as a development platform influences every other blockchain development ecosystem. Every other blockchain development ecosystem sees what Ethereum is doing. They're like, oh, well, they work hard and build cool tech. We can too. And so I think Ethereum represents the accelerationism of being able to build better tech. So I think these two forces are pretty much unstoppable. One is foundational infrastructure, the other is innovation. And considering these powerful forces, there's going to be a long, strong, multi-year vision for crypto in the many years and decades to come.
All right, folks. Well, that's it. You heard it yourself from Brent Xu. Bitcoin will never die. Ethereum is a call option on the future of all blockchain technology. Uh, Cosmos SDK, and in Brent's opinion, what is needed to really make DeFi sustainable and take it to that next level is more real world use, more synergy between legacy structures, legacy finance, and crypto itself, which I 100% agree with. So, those are all really interesting insights that you shared with us today, Brent. Is there anything else you want to say to the world?
Just keep building, guys. Just don't stop. Keep building, keep developing, and we're all going to make it. Wag me.
Yeah, exactly. If people want to know more about you, follow your insights, and keep up to date with you, where's the best place for them to do that?
Certainly. Feel free to follow me on Twitter at bond_dog_51. I share a lot of insights there, and looking forward to seeing everyone out there in the broader ecosystem. Just a lot of good stuff that we can build together, and I'm very excited for all the future possibilities of this tech.
All right. Well, Brent, thanks for coming on. Viewers, thanks for tuning in to Market Talks. You can find me here every Thursday at 12 p.m. Eastern.